So our next chapter here that we're looking at is taxation. Taxation, I suppose it's not too much of a jump up from what you would have seen in junior cert, but obviously that's a couple of years ago. So um, very briefly, what is taxation? Taxation is a levy imposed by governments on individuals and businesses. So it's a levy. It's basically, what is a levy? It's a charge. So individuals and businesses have to pay this charge, and the money goes to the government. Um, there are a few slides, quite a few slides that I'll get you to take down. We're only going to do about uh, 8 or 9 slides today, but this is obviously one that I'm going to get you to take down. So taxation is a levy imposed by government on individuals and business. Taking that down to your notes copy, and if you're not sure what a levy is a charge. So reasons for tax, there's 3 here: government revenue, redistribution of wealth, and discouraging consumption. And that's generally the main reasons why we would tax. So government revenue obviously is a government in terms of trying to finance everything for the economy. Government isn't a money-making machine. The money has to come from the people. Redistribution of wealth, more often than not, we're looking here at social welfare. So obviously you have people maybe that are unemployed, people that might have some disabilities, or any kind of even child benefit or anything like that, where there are people who may not be in a position to earn for themselves, and therefore they'd have no income. And if you have people in the in your country that don't have any income, obviously that leads to poverty, that leads to increased crime, and a lot of social issues that come with that. So social welfare is very important. Where would you get the money for social welfare? Where would you get the money to pay people for these social benefits? Well, you generally have to tax. You'd have to tax people, and the more you earn, generally, the more you pay. And discouraging consumption being our last one. So for discouraging consumption, generally, obviously, we're taxing something that we do not want to be done in excess, or something that we're trying to discourage. So cigarettes are taxed every single year in the budget. The price goes up. Alcohol is more or less taxed every single year. The price is constantly creeping up. Now, and more so than ever, you're finding there's more tax put on certain products or services that would use a high amount of carbon emissions, and that wouldn't be eco-friendly. So you're trying to discourage things, obviously, that are bad for the environment, or obviously maybe bad for individuals themselves. That's what I mean by discouraging consumption. Direct and indirect tax. So very briefly, these are taxes levied on the income earned by a business or household, and paid directly to the government. And indirect tax are levied on what you spend. So direct tax generally comes out of your income, and an indirect tax comes out of what you spend. So for example, if I go into a shop, I pick up a carton of milk. The milk, if I look at the receipt after I purchase it, the milk might be actually, its price might be €1.60, but there might have been a 23-cent tax, that was on that carton of milk. So the indirect tax there would be my VAT. It's the VAT I'm indirectly paying to the government. I'm paying it to the shop, and the shop will give that money to the government. Whereas direct tax might come directly out of my paycheck. It'd be my PAYE. It's money that in my case I'll never see. Direct tax comes out of your income. Indirect tax comes out of what you spend. So I'll get you to take that down. For the last 2 slides that we looked at, you're taking down both the 3 reasons here for taxation, and taking down direct and indirect tax, and just take on below it. Direct tax is tax on income, and indirect tax is tax on spending, just to make it as brief to help you understand. The taxes paid by households and business. So what are the taxes that a household and business would pay? Well, there are some taxes here. We'll look at 7 of them that both households and businesses pay. So what I mean by households and businesses, I as an individual, or somebody as a family, or something like that, these are taxes that we would have to pay. And also you'd have someone who's running their own business, and this is money that the business would also have to pay. So it's tax that everybody pays. VAT is your valued added tax. It's a VAT is tax on goods and services paid by both households and businesses. This is your tax on the carton of milk. It's your tax on, buying a loaf of bread in the shop. It's your tax on everything. If I'm buying a new laptop, I have to pay tax on, or that's my tax I pay on that. It's VAT is basically a charge on everything that you buy. Motor tax. So obviously, if you were to buy a new car, or if once you're 17 and you're trying to get your provisional license and you're on the road and you might share a car with someone in your family or something like that, every year a car needs to be taxed. So that's what our motor tax is. It's compulsory. You cannot drive. We looked at that in the last chapter. You cannot drive without your car being taxed. Capital gains tax. This is a tax on the gain made when a business or household sells an asset. So what we're looking at here is that if you were to sell your premises, if you were to sell your buildings, there's a portion of that will go towards the government, and it's our CGT, it's our capital gains tax. Custom duties, tax levied on goods imported to Ireland from countries outside the EU. If you are ordering from anything based in the UK, or something is manufactured in the UK, there are a lot more charges coming, and these are basically duty charges. So these are custom duties, because if you were to import something from America, before, you generally expect to pay an additional couple of charges on that delivery. No, you're going to have to pay, generally, for depending on the company, we'll probably have to pay a good few more charges on products coming from the UK because of custom duty. It's a tax levied on goods imported from a country outside the EU. Excise duties, tax on things we want to discourage, so alcohol and tobacco. As I said briefly earlier, that we're trying to discourage people from using them. People do purchase them, so the government looks at this as a way of, let's hike up the price, get as much money as we can from it, and also in the hopes of discouraging people from using them. And it's been quite successful with tobacco products generally. I would say that there's much fewer people smoking these days than there would have been 10 years ago, or obviously a lot more before that as well. So it can work to discourage people by just hiking up the price. Carbon tax is a tax on products that emit carbon. So obviously we looked at things that are damaging for the environment. And again, we're just taxing that to discourage it. And obviously there's certain rules and regulations put in place. So if you're building a house in the future now, you can't put a chimney in that house. There's certain things that you have to have an air to water system, all these environmentally friendly procedures that are going to be put in place. And you'll find that there's going to be additional taxes put on, let's say in the future, when most people start buying the electric cars or hybrid cars, there'll be higher taxes put on petrol and diesel. Just because at the moment most people are driving petrol and diesel cars, but there will come a time where you'll see that starting to shift, and most people will turn to probably hybrid cars or the electronic vehicles. And then once that starts to happen, the government will say, okay, now it's time to start taxing diesel and petrol cars and start putting up a bigger tax on them. And obviously then getting more people to turn to the environmentally friendly models. PRSI is the last one, pay related social insurance. So it's a statutory deduction made by employees or employers on behalf of the revenue commissioners. And what PRSI goes to, everybody would pay it out of your paycheck. And that basically goes for social benefits. That's the money that they put aside to pay for maternity leaves or child benefit or disability allowances or job seekers benefit or anything like that. These social payments that people receive, the pandemic unemployment payment, that's the correct term for your COVID payment. So it's the pandemic unemployment payment, the PUP. Again, that's just another social payment. And then the money is generated from PRSI. They charge people PRSI and they put that money towards social benefits. Couple more, so we're just going to look at the last 3 slides. Taxes paid by households only. So this is basically just individuals, whatever, just any working person, but we're excluding businesses. PAYE income tax is a direct tax on your wages. Your PAYE stands for pay as you earn. going to take that down. It's pay as you earn, and it's a tax on your income. It's your income tax. If you're running as a self-employed, a sole trader, where you are a small business, or you're running anything at the side, you're having a second form of earnings from something else, you could have a self-assessment income tax. So this would apply. We looked at this before for organization ownerships. Self-assessment income tax would apply for sole traders, and it would also apply for partnerships. When we say businesses, what we really are looking at are the private limited companies and co-ops. So for self-assessment income tax, it's just for individuals who might have a job where they're being hired to do something, and they're in a form self-employed, or else just looking at sole traders and partnerships. So self-assessment income tax is a tax paid by self-employed people on their business profits and other incomes earned. So if I open up a barber shop and I start bringing in, basically customers, if I charge, let's just make it easy, and say that we charge every customer €10, I might have to go back at the end of the year and calculate how much of my income that I've earned do I have to assign to self-assessment income tax. So obviously, let's just make it easy and just say that 20% of all my earnings needs to be taxed. I'll go back through my entire earnings for my whole year. Again, I charge €10 per customer. If I've had 1,000 customers over the whole year, then I've earned €10,000, and I'll need to give away 20% of that to the government, and I'll have to self-assess that myself. And the revenue commissioner generally will kind of check in with people to see, are they paying their taxes. USC is our universal social charge. It's paid by all employees and self-employed people who earn more than 12,000 per year, and again it would automatically come out of your paycheck. DIRT is deposit interest retention tax. So DIRT is a tax on interest on savings. So if I have a bank account and I'm earning interest, let's say I'm earning, I have whatever, let's just say someone has 100,000 in the bank and they're earning interest at, we'll say 2%, but it's much, much less at the moment. It's very, very, very low. You are earning absolutely no interest at the moment. But let's just say it's 2%. So my €100,000 would earn €2,000 interest every year. They'll then tax that. So at the moment, I think the DIRT is 33% tax. So my €2,000, I'll lose 33% of that. So €2,000 I earned in interest, I'll lose about 33% or 35%. I forget what it is. And that's basically my DIRT tax, deposit interest retention tax. So it's a tax on interest earned from savings. Local property tax is a tax based on the value of your residential property. It's a tax on your house. And how we go look up paying this, so your local property tax, again, is you decide how much you're going to pay, which seems ridiculous. What you're basically doing is, the more your house is worth, the more tax you pay. But you decide how much your house is worth. They don't go around and assess people's houses. So if I think my house is worth $500,000, I'm going to pay more tax than if I think my house is worth 350,000. So obviously, generally, this would probably encourage people to pretend their house isn't worth much, so they'll pay less tax. But you could, later down the line, you could incorporate, or you could run into some trouble if you decide your house is only worth 300,000 just because you want to pay less property tax. What happens when you're going to try to sell that house? You've devalued your house. What happens if you have a fire and your house is completely destroyed and the insurance company finds out that this house that you think is worth $500,000, you've been only telling the government it's worth 300,000. So you'd have to be some way wary of that. So local property tax, LPT, is a tax based on the value of your house. CAT is capital acquisitions tax. Is a tax on gifts and inheritance. Unfortunately, if you were to inherit a large amount of money from somebody maybe who passed on, you get a lot of money from somebody from their will or something like that. It could be subject to capital acquisitions tax, where you could lose a certain percentage of that money as a form of tax. Just about everything can be taxed. The last two we'll look at is, do you know what, I'll look at this the next day because it's running up in 15 minutes. we're at slide 9. There is only a few slides and there's not much writing in most of the stuff we looked at, but I'm going to get you to take it all down because it is quite important. So what is tax? Again, there's 3 things there for reason for tax: direct and indirect. And then we have our 7 taxes here, which are short explanations next to them. And we have our 6 paid by the household only. So the 6 paid by the household, the 7 paid by households individuals, and then this is just direct and indirect reasons for tax and what is tax. If there is anything at all that you were unaware of, because obviously the benefit of being in class is that I can people can ask if they're not sure of anything. If there is anything you're unaware of from the notes, you can ask, and if I have explained anything in more detail, so for example I've gone into more explanation here as to what, let's say, redistribution of wealth is for reasons for taxing, that we're taking money from people who are earning and we're giving it to people who mightn't be earning, it might be handy for you to take down a few additional notes for yourself as well.